one hand, while this is great for maybe encouraging some folks to go under contract and buy a home and lock in their rate, or to maybe come back and refinance one more time, it does really point to the fact that all this uncertainty is not good, generally speaking, for financial markets. And while we are just revised our full year forecast upward to about little over 1.6 trillion, which will be bigger than last year, versus a previous forecast that would have had a contracting market with interest rates rising. We do expect that there'll be some form of hangover effect that once rates do rise, and we are expecting the Fed not to raise in the short term, but to raise before year end, that we're going to ultimately be dealing with what will have to become a predominant purchase market. So all this uncertainty deals with all of you on a day-to-day basis in Washington. A trig rule without clarity, not knowing what errors you can correct, particularly in the jumbo space when quality control firms are reviewing your files before they purchase them, and the rejection rates were high, particularly in the early phase. These are things that we focus on every day. So let me just start with the basics. The thing that I spend a lot of my time on these days is what's going to happen in the transition to the new administration. HUD, Secretary Castro is a candidate potentially on the short list of a number of candidates for a VP role. And I think the focus at the senior levels of HUD is not where we want it to be. It's not on giving clarity to loan level certifications and dealing with False Claims Act risk. The HUD, in my view, is very much in a transition phase to what it will ultimately look like in the next administration. A lot of the long-term political appointees have left. There are still some people there who are keeping the organization running smoothly, a lot of good, great career staff there, but it means in critical policy areas, we have a lot of work to be done that we need to depend most likely on the next administration for. Likewise, in the White House, we had a core team in the administration that focused on housing issues, worked with the various regulators to try to bring clarity to the rules and policies in support of our industry to try to get housing back on track more broadly. And unfortunately, a lot of the core housing, key housing talent in the administration has also left, as they have at the Treasury Department. The two most important regulators in your life outside of HUD and the connected parties in the Department of Justice and elsewhere are clearly the FHFA and the CFPB. FHFA has actually done a really good job for all of us. They've created rep and warrant clarity over the past several years, working with a working group with MBA, where we ended up being able to get clarity under what kinds of defects were material enough to cause you to ultimately potentially be on the hook for indemnification or repurchase, what kind of remedies were in place in the event that there were defects. That's been a great model, but I want to remind everybody that Mel Watt's term is limited by his appointment, and his about that if we do some Q&A and we start talking about Fannie and Freddie and what may happen there. On the CFPB front, I know the CFPB is not the most popular regulator in the industry, but they exist. Dodd-Frank's not going to go away, and I don't care which president will scale back Dodd-Frank in any meaningful way, because there'll be no party that controls enough strength in Congress to be able to get that kind of outcome. But I will tell you that my own view of the Bureau is working with Rich Cordray has generally been positive. He listens to the industry. We have great access to him. And while we haven't gotten the rules the way we want them every step of the way, they're a lot better than they otherwise could have been. The patch is a clear example in the QM rule that allows us to underwrite loans to a broader credit box than an Appendix Q and a 43 debt-to-income ratio. And we could talk about a number of issues that the Bureau, on the policies the Bureau has rolled out, and progress that was made by our engagement, and how much worse they would have been had the Bureau not listened to us. Today we're very engaged with the Bureau on trying to fix some of the trig rule so that we can get better clarity in terms of how we comply. And we're commenting on that aggressively. Obviously, the Bureau is clearly stated that they are putting some of the rule out for comment, and that's really at our request because we want to try to get clarity in terms of how we can amend certain errors, what's fixable, what's not fixable, so that we're not exposed to a legal response either through personal rights of action or enforcement from the Bureau, or potentially from other measures from investors who could come back and require repurchase or indemn down the road if and when a loan goes to default and they identify errors based on the know before you owe rule. But there's a lot of things we continue to work on with the Bureau on a regular basis. On Capitol Hill, there's also going to be a huge transition in the next administration, no matter who takes control. We all deal with two primary committees, the Senate Banking Committee and the House Financial Services Committee. On the Senate side, the possibility for a changeover to Democratic leadership is very high, particularly in the event that Secretary Clinton is elected president. It's a narrow margin in favor of the Republicans today. The Republicans have many more seats up for re-election than the Democrats, so their exposure to turnover back to a Democrat-controlled Senate is very high. It only becomes higher in the event that the Democrats win the White House, which many odds makers put as probable. Of course, that's too soon to tell. On the House Financial Services side, Jeb Henseling chairs the House Financial Services Committee. Maxine Waters is the ranking member. They've been actually very active in promoting legislation related to our industry. Not much has gained traction because of the very significant partisan divide there, but just as an example, the one bill that actually went through with virtually unanimous support was the transitional licensing bill, which went through committee, and that's a piece of legislation that I think is near and dear to all of you, especially those of you who work for non-bank originators, because it's a tool that would allow you to transition employers without being burdened with the inability to originate mortgages, particularly if you go from bank to non-bank. Or should a loan officer move from California to Hawaii and want to keep doing loans while they get licensed in the state, this transitional licensing bill allows for that kind of workforce mobility, and that's a really important piece of legislation that we've been advocating for. It has gone through the committee in the House. We think it has probably the greatest opportunity to go through a full Congress, but none of that will become relevant until what we call the lame duck. After the presidential election, once both parties know who's going to take over the White House come January, then they all want to negotiate to try to get what they can get done before the remainder of the term. And for those two committees I talked about, the chair of the Senate Banking Committee is Senator Richard Shelby from Alabama. His term, it terms out at the end of the administration, and he is not That's what makes the lame duck period even more likely that negotiation will take place in order to get things done. It's quite frankly where you might see some efforts on some GSE reform measures as well. So we could see an active Congress come the post-election cycle. Between now and then, the two focuses have been really two core issues. One got basically resolved last night, that was Puerto Rico. And the second one is the Zika virus and working on a solution for Zika and getting resources for it. That's a true national health hazard, and in all our congressional briefings, I can tell you that's primarily all they're focused on. We could talk a lot more about what's going on in the housing finance space, what's likely or likely not to occur. I just want to round the corner with a couple of thoughts. I know you guys look at your business and what may happen over the long term. Is this a good career path for young people to get into? And if I was in front of you, I'd be showing you slides on demographics of this country. But this millennial generation is the real deal. It's the single largest cohort of the labor force. The oldest of millennials are just reaching their first period for home purchase activity. That generation is much larger than the generation that I was part of when I joined the mortgage industry, the baby boom generation. And we drove mortgage finance for the last 3 decades. First homes, second homes, move-up homes, retirement homes. That was our generation. And this millennial generation is huge. It's going to create somewhere in the range of 1.5 million new households every year for the next decade plus. You are going to see robust demand no matter what happens going forward. And so, from my perspective, we are in a great industry. We build communities, we finance the homes that people are going to need. I actually think our greatest challenges are going to be around access to credit, making sure the rules are flexible enough to allow us to make good common sense decisions without legal risk or enforcement risk. That isn't the case today, and I think that's going to be an area we need to focus. Second will be inventory, making sure that we have affordable housing. That's obviously important in Hawaii. I mean, your average loan size is about $440,000 compared to the mid 200,000s for the rest of the country. But I think because of the high price of housing in Hawaii, you see it also in terms of your home ownership rate, which is lower than the mainland, and your rental to ownership mix is higher rental, less home ownership than the national averages. So in my own view, that's a clear focus on a variety of variables, but one of the variables is affordable housing stock. And then the third leg of the stool here that I think we're all going to have to focus on going forward is making home ownership something that we're proud of. Previous presidents in this country used home ownership as a core primary plank to their efforts. They talked about it publicly. And unfortunately, this administration had to deal with the housing recession, and most of the focus of this administration, as one who spent time on the president's housing team working on a lot of these solutions, was dealing with trying to protect borrowers in distress in their homes, trying to put rules in place that would ensure that, no doc, fog the mirror, 100% finance, 228s would never come back again going forward, and putting parameters in place that would allow us to make sure that future borrowers were sustainable going forward. I think those causes were noble, but this administration has yet to talk about the opportunities to be homeowners. And we're going to be really pressing the next administration, whether it's Clinton or Trump, to focus on housing. I've personally met with both of their teams. That Terwilliger Foundation, that in my introduction is a bipartisan foundation. I sit with Scott Brown, who's a key advisor to Donald Trump. We work very closely together. We've been meeting with Scott regularly on housing policy should Trump get the job. Or in what I think is the more likely case that Secretary Clinton gets the job, and I'm not making a political bias statement, I'm just talking about the numbers. Should she get the job in the White House, there's been a whole team that's working very closely with Secretary Clinton and her key advisors who are really fleshing out, at this point, they're much more ahead of the curve on thinking about housing opportunity, and she has already written a plank on first-time homebuyer matching savings credits and a variety of other areas, which I think will be very helpful to spur housing. But, for all of you, you've been dealing with nothing but pain these last several years, dealing with thousands of pages of regulation and wondering why people in Washington don't get it. And quite frankly, that's a challenge, but we're at a point now where all the rules of Dodd-Frank have already been rolled out. The last rule under the Senate obligation is the HMDA rule, and we're going to be implementing that, and we have privacy concerns and a variety of things we'll be dealing with on that implementation. But really, that's it for Dodd-Frank. And so our job going forward here is to refine the rules, make them better, make housing a priority for this administration coming in, make sure we work with the new leadership coming in, that we know everybody and every regulator like we do today, and then we get really embedded with Congress to have them try to be more productive in clearing out some of the red tape that inhibits your ability to provide real estate finance to the communities you serve. So that's it. A few opening comments. At this point, I'd be glad to answer any question on any subject you have whatsoever.
Dave?
Rob?
How you doing? It's amazing.
Good to see you, man.
I can't walk from my kitchen into my garage without losing my cell phone connection, and here we are talking 6,000 miles away. It's amazing.
It takes those kind of connections for us to see each other.
There you go. So you travel around the country a lot, and you visit with different organizations, and as I do, and sometimes I'm asked, why should I belong to the MBA and the state or local organization? What's the advantage? What's the disadvantage? Are there any disadvantages? I know that different groups around the nation have seen their enrollment decline or increase. This group right here is very strong. And so I thought maybe you could address why somebody should belong to the MBA.
Well, thanks, Rob, and I appreciate that question. I'll give you your payoff later on. Here's my own view, and look, guys, I just started as a loan rep. I got a Bachelor of Arts degree from the University of Colorado and spent the first years of my life partying before I figured out to get in the loan business. I fell into this by accident, but over the years, I've ended up in some senior roles and learned the business through as a practitioner, like most of you have, quite frankly. We are fighting a war. Let's make no mistake about it, and it's at the federal level and the state level. And the view of lending, the view of regulation, the overlapping roles that regulators play today that impact your ability to serve homeowners is extraordinary. I grew up in a world where the center of housing finance was New York City. And I used to spend my time on Amtrak heading to New York to meet with investors and bond buyers and traders. Today, the vast majority of us spend our time inside the Beltway in Washington because it's federal law that it can ultimately decide that. But it's state law as well. And the partnership between state associations and the National MBA is critical. We focus inside the Beltway, states focus in the states. There are times when we all need to work together on state laws that can be extraordinarily dangerous if they're expanded. And so we work together when those are possible. Getting a uniform standardized test is a simple example of how states and the National MBA work together, and that's just one small example. But, you know, I will tell you, as a guy who worked in the administration and saw all these little differing lender trade groups calling, oftentimes pointing fingers at each other, but calling on us in Washington to try to listen to them, it gets really confusing. The way you're effective as an advocacy organization is you're organized. And I hearken to the National Rifle Association, who, no matter what you think about them, they don't have like the handgun owners of America subgroup running around Washington, D.C., or the deer hunters with 20-gauge shotgun organization. It's one group, and they stay aligned, just like the National Education Association stays aligned, the National Association of Realtors, one institution, huge, powerful, and badass. And for the MBA, the reason why I actually came here after leaving the administration, I was headed back to the business, and it was a group of members circled their wagons and asked me to come join here, was that we all recognize we need to unify the voice of our industry. And in Washington, being unified, representing large, small, bank, non-bank, retained sellers, name it, that's what makes us really powerful. And that partnership at the state level is important. In my own view, if you're a lender and you're not a member of the state and the national, you're getting a free ride. And this needs to be considered a core investment of your organization to participate. You talked about growth. We added over 400 new institutional members last year. 40% of our members are community banks, and about the same are independent mortgage bankers. We represent the entire ecosystem of housing finance. And in D.C., we've got 130 employees right here in my building on my floor that represent single-family policy, lobbying efforts, the best economists in the nation. Our lobbyists are deep. My Democrat Senate lobbyist, Brad, worked for Hillary Clinton in her Senate office when she was in the Senate. I mean, we have depth that is unmatched. There isn't a single trade group in the world as large and as powerful in mortgage finance and the Mortgage Bankers Association by leaps and bounds. So, obviously I'm being a bit passionate here, but it's really important that everybody be a member. And by the way, I've been a member of the MBA in my career ever since I started, and I've run independent mortgage banking companies, small ones, and I've worked for large, big dogs. And in the end of the day, I just consider it as a core fundamental to what we do, because we've got to all stay aligned together. We need to make the sausage behind closed doors, but when we go out front to policymakers, it has to be a unified front, or we'll never accomplish what we need to accomplish. Thanks, Rob. Don't be shy. I should have had my Hawaiian shirt on. I apologize. Be more relaxed.
Hi, David. I'm Chris with Pacific Rim here
Hey, Chris.
in Hawaii. Do you have any statistics on if anyone in the United States has opted out on the 3-day right of rescission on the CD at all? Anybody? Anywhere?
Yeah. Does anybody in that room have anybody who's opted out of the 3-day right of rescission? Can you even opt out of that 3-day right of rescission? You know, it's a great question, Rich, and I think, you know, the frustration you guys have is these lockdowns are so tight that if any error happens, you got to start the process all over again. Any minor change that causes enough of a change in the APR. So I know that's a real issue. These are things we're going to have to modify in the rule. I'd ask for a perspective here. We all know that there were a lot of unsustainable programs in the market pre-recession. And I remember in the mid-2000s, in the business, talking to my friends going, man, you know, this cannot last the way it is. And when the collapse happened, it was worse than anybody expected. Any of us expected either. Took down, you know, Countrywide, and Wachovia, and WAMU, and all these companies went down as a result. And the reaction, in my view, was a clear overcorrection. The pendulum was way too far to the left. It swung way too far to the right. It's not surprising to me that all of this regulation occurred and that now we have rules that in many cases, while we're working within the confines of them, they need changes. It's because everybody decided they were going to correct our problems for us. And I do think you're going to see things only get better as time goes on. We've come through the worst of it, in my view. And while we still have to worry about fair lending concerns, and I think that's got to be a strong area of focus for any institution in the market right now, I think we have some opportunity ahead to expand back and at least with reasonable guidelines, really make the regulators recognize that, you know, we can make good, conscious, subjective decisions within some parameter to allow a borrower to get a home without having to risk our firm or some form of legal enforcement that only makes it unnecessary and less desirous to be in the business in the first place.
Any other questions?
Well, you're quiet.
They're all
Round two.
Yeah, round two. Well, they're all too polite to ask questions. Dave, are you actually wearing pants, or are you? We can only see you from the waist up. No, I had a question about the MBA has been notoriously wrong in their volume projections and interest rates projections, starting with Jay Brinkman, before Jay Brinkman, Mike, and so forth. And I know you guys just revised your 2016 estimates. So volume is on the upswing. How might that change given what's happening in Europe and so forth? And what do you see in terms of projections, first-time home buyers, you know, FHA, VA, conventional, and so forth through the rest of 2016?
Yeah, so I'm not going to rattle off all the data, Rob, although I can send you our new data sheet. We just revised our forecast a couple days ago. But look, Brexit was a complete surprise for the world. And I think the surprise, quite frankly, the benefit of all of you is that we've seen a lot of technical adjustments in the mortgage markets really as a result primarily to flight to quality outcomes. And so whether it was weakness in China, or the most recent case of the Brexit vote, we've just seen you know, technical aspects happen overseas. It's bringing a lot of demand for the treasury markets, and that's creating the rally that's driving rates low. Look at the Brexit vote. On the day before the Brexit vote versus 5 days later, the 10-year rallied 30 basis points. And you know, we're already seeing the equities markets have recovered the last couple days or come back somewhat, taking back some of those losses. But if you look at the day before the Brexit vote, the markets rallied and interest rates corrected, right? And then, and to the surprise of everybody, every analyst, economist across the globe, Great Britain voted to exit the European Union, and suddenly it created this massive reaction, an extraordinary flight to quality, created the 10-year rally, and all of you hopefully called everybody you know to lock in. But that was a phenomenon that was unexpected. I think we've seen that over the past many years. We continue to believe the Fed's going to raise rates. We know that we just had a meeting with Janet Yellen and all the Federal Reserve chairs in November of last year, but it seems like yesterday. But that was it was clear that they were worried about an overheated market. And while they're clearly going to be cautionary now based on concerns about a European slowdown and what's the impact going to be in Great Britain, which has a significant impact to Western Europe, those are going to be things that are going to modify the outcome. But this economy is going to continue growing, and even though it's somewhat sluggish growth with the last GDP figures, it's going to continue growing. And all of our analysis has been right on that aspect. Our home sales predictions have been accurate. It's just the refi activity we can't predict due to this volatility in the interest rate markets. But when the Fed rises, it's going to take a really good salesperson to sell someone into a higher interest rate on a refinance, and that's going to be something that's going to be more challenging. So all I would say at this point is, yeah, I mean, you want to, one thing for certain, whatever an economist predicts is going to be wrong. They're never accurate. But with this kind of volatility in the markets, it's even more so the case. So we're putting out new data. We just released a new forecast a few days ago, and the breakdown between FHA and agency is going to really come down to what FHA does with their MIP premiums, quite frankly, and that's going to be the biggest driver between those two.
Thank you, Dave. Hello, this is Carol Marks, the president this year for the Mortgage Bankers Association of Hawaii. Thanks for your time today. I just want to ask on behalf of the Hawaii residents, if you can do anything in Washington, D.C. to lower our tax rate in Hawaii so we can afford more housing. I think we can lift the the ownership ratio here in Hawaii, but I know that's a stretch, but I'm throwing it out there because we do need some help, and appreciate your thoughtfulness on that. But any thoughts on...
It's interesting how various state income tax levels vary so wildly in this country, and likewise property tax rates. And that clearly, you know, housing in the end of the day is an elastic good, and it's impacted by all of these variables. So I will tell you that regardless of tax rates, your demands for housing are going to continue to rise in Hawaii. And you know, someone spoke earlier from the podium, I think it was from the governor's office, about 20-somethings living with their parents. That is shifting. The percentage of college graduates living at home is we're now starting to see the change, and it's resulting in new household formation. So we're already seeing it this year, and so there will be demand for housing, whether it's rented or owned. That's going to ultimately be impacted by things like tax rates, et cetera, and affordable housing supply and student loan debt and all of those kinds of variables. But we do know it's an issue. I doubt Congress is going to focus on Hawaii's income tax rates, or their property taxes.
Hi, good morning. This is Linda Nakamura with First Hawaiian Bank, and I got to see you at the National Advocacy Conference, so good to see you again. I have a question with respect to super liens. Here in the state of Hawaii, we obviously, land is scarce, we have a lot of condos. So each state, I know various states have various super lien legislation, and we do have one as well. And there are other states whose super lien legislation is very, very scary, where they're looking at 6-month super liens as a rolling super lien, which may wipe out the first mortgage lien. So what is the MBA doing to help the various states in trying to fight this?
Yeah, so thanks for the question. I think you guys are all aware these are HOA super liens is the big concern, and we've been working very closely with Nevada and some of the other states that are dealing, Arizona and some of the other states that are dealing with these issues. Look, it's inconceivable to me that legislators would pass legislation that give homeowner associations a super lien right over the first deed of trust. And we don't have to walk through all the variables there, but you know, there's no regulation that oversees how homeowners associations operate, and the ability to implement special assessments, to build a pool after the fact, or any number of things that can cause homeowners associations to make bad decisions, has no governance. And so their rights to take first lien rights, I think ultimately if that kind of law were to expand on a national scale, would have to create some sort of haircut on the investor side, particularly on the first lien side. So we have enough problems with condos, as you well know. The condo restrictions with the GSEs and FHA, how they count home ownership rates, owner occupancy rates in condo buildings, and things of that sort are a huge challenge. This is just another impediment to lenders wanting to finance condos or PODs that have a homeowners associations. So we're very active in the space, and I'd encourage you to reach out to me after the call, and I can have our policy guys follow up with you. William Cooper and Scott Nowak and our team interact with all the state associations, and we can share with you everything that we're working on right now. But yeah, it's a big deal.
Thank you. Actually, I've been working with Will here.
Oh, perfect.
Hi, Dave. Shelley Suiso, Federal Home Loan Bank of Des Moines, Iowa. As you probably know, we've got the largest footprint in the nation right now for our Federal Home Loan Bank. And I travel the Pacific Northwest and represent about 8 of our states. And it's really a big pleasure to be with this group. This is an amazing group of mortgage bankers here in Hawaii. And it's the 3rd year I've attended this conference. But one of the things that I'm asked everywhere I'm traveling with right now is why independent mortgage bankers cannot be a part of the Federal Home Loan Bank system. And I would be very curious as to an update on the advocacy that the MBA is doing to try to get them part of the Federal Home Loan Bank system so they get access to our low-cost liquidity, which we know would be a huge game changer for them and their cost of warehouse financing.
Yeah, well, thank you. And obviously, I know Dick really well from Iowa, who headed that Federal Home Loan Bank up until the merger. There's varying views, as you know, and I don't need to tell you this. There's varying views amongst the Federal Home Loan Bank system as to who should be allowed in and who should not be. My own view is that the Federal Home Loan Bank should be a tool that we think about from a housing policy standpoint to provide liquidity to the overall mortgage finance space. When these Federal Home Loan Banks were created, and the first rules were put in place back in the 1930s, which is the legal reference that a lot of people look at, particularly the Federal Housing Finance Agency, when they're thinking about rules of governance for the Federal Home Loan Bank system. There wasn't a network of independent mortgage bankers supporting housing finance in this country like we have today. But it is in essence a private club, and people like to protect their private clubs. And so if you're a community bank member of a Federal Home Loan Bank anywhere in the country, the likelihood is you prefer not to let everybody else in because it gives you in essence a competitive advantage, a source of borrowing that others don't have. You saw that recently with the policy change from FHFA that modified the ability for captive reinsurance companies to maintain membership in the Federal Home Loan Bank system. I don't want to get into a battle of business models. My own view is we should have a level playing field for all lenders to access government-supported forms of capital regardless of who you are. So that should be the same with the GSEs, it should be the same with Ginnie Mae and the various programs that feed into the Ginnie Mae security, and it should be the same for the Federal Home Loan Banks. And at a time like this when if you're an independent mortgage banker and you're engaging with Ginnie Mae and you sell your servicing, the available liquidity providers to buy MSRs, Ginnie Mae MSRs, is rapidly going away. And that's a huge risk to the industry because it's non-bank originators who actually do a lot of support for the FHA program in this country today because many of the larger financial institutions have backed away due to legal exposure and enforcement risk. So in the end of the day, I think the Federal Home Loan Bank system has to be part of the dialogue. Des Moines has been a very positive, proactive supporter of trying to work to get to a conclusion where we can get some unity around this effort. They were one of 10 federal home loan banks who wrote a joint letter to FHFA when this issue was coming up for rulemaking. But unfortunately, it's not moving in our direction. And I'll just end with Director Watt, who was ultimately the decision maker in this effort, has said publicly that we need Congress to act. So I think the only way we're going to get something changed here is through legislation. We are working right now with select members of Congress on a piece of legislation that would at least modify some recent changes in the FHFA ruling related to the federal home loan banks. But this really needs to be part of a larger dialogue that we all engage in. So I'd love to engage with your MBA as well as the other state MBAs to work on this.
Thank you, Dave. And do you have time for one last question?
Absolutely.
Okay. And this is PJ Harrigan.
Where's your pen?
PJ.
Hey.
Sorry, PJ.
Hey,
Hey, for all of you who don't know, so I just got my certified mortgage banker just before the big October conference. Went through the test, and it was PJ who literally was on the phone with my wife, making sure my wife was making me study for the exam. So that's the extent PJ will go through to make sure you pass your CMB, which is not an easy task. So
you know,
PJ,
there's only one CMB in the state of Hawaii. But there is a CMB in Hawaii. Two things. Can you talk about the importance of advocacy and being involved, and how you can do that? And then also, the MBA just sent a letter to FHFA about fees on loans. Can you talk about the response to that, or has there been any response to that?
Yeah.
Thank you, Dave.
Yeah, so we'll cover that, and then all you guys who are nodding off because this is taking too long can get some coffee and wake up, hopefully. So, two things. So, advocacy, you know, I hate politics. I'm as frustrated with everything that's going on in Washington as all of you are. So let's just put that on the table. The problem is that it's these people in town who make things happen, or don't, and who can make good things happen or bad things happen, depending on what side of the issue you sit on. We work in an industry that's been one of the most legislated and regulated from an activity standpoint of any industry in America these last 5+ years. So advocacy is absolutely important. I worked on the president's housing team. I was a regulator, and I was called on constantly by people who wanted to come in and talk about their issues, and I met with everybody. Members of Congress listen to you. When you write a letter, and I know your association says the same thing, when you write a letter to your member of Congress, they pay attention. I'm on the Hill all the time. I was on the Hill a ton this week, primarily on the Senate side. And every time I'm in an office and the phone's ringing off the hook, and you usually have people at 2 front desks in the front of a Senate office, young people answering phones, I'll always ask them, what's the issue today? And they'll tell me, whether it's whatever it is. So they listen, they keep track, and members will tell you when they're going to go, man, ringing off the hook on that subject. They know it. They may not be answering the calls, but their staff are informing them and they care about it. So if you think your voice doesn't matter, you're really, couldn't be more wrong. A simple letter or email is the way to go. But I want to ask all of you to do one thing. PJ, thanks for the soft sell on this one. Join the Mortgage Action Alliance. It's free. It's online. It allows us to reach out to you when there's a piece of legislation going through or we need your help. It's fully automated. All you got to do is hit a button. It'll pick your member of Congress or your senator. It'll pre-draft the letter, and all you got to do is hit send. If it's an issue you don't support, you don't have to send anything. But we don't know how to reach you if you're not part of this, so you need to join the Mortgage Action Alliance. That is at its base the way you become an activist for your industry and for your own pocketbook as you think about moving forward. So I'd ask you to do that, and it would be one small effort. The letter to Mel, we joined in with a group of trades, the realtors, the bankers, the home builders, and more. We sent a letter to Director Watt because we believe that when you take low-level price adjusters, and excuse me for any Freddie or Fannie member in the room there, but we've gone to Leighton and MBAH on this as well. When you take the low-level price adjusters, private mortgage insurance, base guarantee fee for a low down payment borrower, we think those that cumulative cost exceeds any true cost of capital and any reasonable economic return that the GSEs should be shooting for. And it's been acknowledged by Ed DeMarco in previous testimony when he was acting director that one of the reasons for the high fees was that mortgage insurance companies were not necessarily trusted counterparties. Today we live in a world where the amount of capital MIs are holding is 40 times greater than it was pre-recession, that the PMIERs rule is now in effect, and by Mark Zandi, the Moody's economist, the amount of capital they're holding exceeds what they would have needed to get it through the recession. And that the combination, when you have first loss coverage from an MI company taking you down to a mid-60s LTV, plus what could be a 200 or 300 basis point loan level price adjuster, depending on your FICO and LTV, is just exorbitant for companies that want to do business with the GSEs, but can't rationalize that price differential. And as we all know, that's if you're in the loan level, maximum loan amount range, that's when those loans go to FHA, which has its own working with them. So our strong belief is that we want the GSEs to be strong. We wanted to have a revenue stream that recognizes their true credit risk, their true cost of capital, and a reasonable economic return. But we believe the combination of the guarantee fee structure and the MI cost and the coverage they get from what are now responsible mortgage insurance companies meeting the PMIER standard is excessive, and that's what our letter called for. So, again, I would really love to come to Hawaii. Trust me on that. It's the best weather and most beautiful place I've ever been, no matter what island. And so I would love to get there sometime in the future, but I hope you have a wonderful conference. Thank you for inviting me and tolerating this video approach. And hope you have a great conference, and hope to see all you guys somewhere soon. And by the way, annual in October, Boston, Massachusetts. I know that's a short flight for you guys. Go around the other side. James Taylor's playing. James Taylor's playing in a free concert. It's going to be a great conference. I hope you guys can come. That's my last pitch. Have a great day.
Dave, thank you so very, very much. We appreciate this. All right. And hope to see you in the flesh next year, maybe. Maybe.
I hope so.
All right.
Now we're going to move right ahead to our next speaker. We're just very, very fortunate to have such a wonderful slate of speakers.